So what a relatively interesting way to finish the week's worth of trading dated Friday the 11th of June 2017. Towards the end or mid-late intraday trading session on Friday, we saw somewhat of a flash crash almost take place on the NASDAQ. You can see here in this particular chart, this is the NASDAQ. You can see this long day outside day candlestick. This is what we call an outside day engulfing Marubozu candlestick, down 113 points. This largely stemmed from, of course, the sell-off which we saw take place in Apple, also for Amazon as well. This was probably the most significant of the pullbacks coming down, and it really just retested a dollar between that level we've identified here at $926 a share for Amazon. The same is true also for Google. You can see this relatively, material-sized pullback. Also, if we pay attention to Tesla as well, you can see a very similar type of candlestick, another engulfing type of candle. Now, the reason for this weekend video is because, yes, this is somewhat concerning. Yes, whenever you see these types of pullbacks, whenever you see these types of corrections, you need to, of course, pay attention to them. But until the technical picture shifts, and what I mean by that is until structure is taken out and until we start to really break down below some of these swing lows, you have to assume that the trend is still in effect. And what I mean by that is when we start paying attention to, again, these rising exponential moving averages, you can see in the past that when we have seen some of these relatively large size sell-offs, they have been very quickly negated, and oftentimes that shows up with either support or the rising 20 or 50 exponential moving average. What's interesting to note is that when we look at the NASDAQ, you can see that we pushed intraday below that 20 rising exponential moving average. However, we couldn't hold below that significant level. On top of that, we didn't even retest or touch that rising 50 exponential moving average, nor are we anywhere close to taking out the past, or at least the most recent swing low, which is priced in over here around 6,000 on the NASDAQ. So look, we do have a relatively bearish sized candle. It is what we call an outside day. It is also coming on elevated volume. But having said that, you still need to assume that the trend is in effect. Oftentimes what happens is when we get up into these elevated levels and when we see a market which is relatively overstretched, overbought, and seemingly exhausted, we'll often see the ADX turn up when we see the bearish pullback, and we'll see the CCI break that 100 signal. Now, what this signifies to us and for traders who are actively participating in the market is that oftentimes the bullish trend is moving into a rest. Now, what we mean by rest is that we get into a general type of consolidation and oscillation between support and resistance. So at this current juncture, you can see, if I just draw on my screen right now, we do have some form of, a potential resistance coming in just above 6,300. But at the same time, at this particular point, you need to assume that this green box on my screen here at 6,000 is going to hold. And what may be setting up is some form of a sideways consolidation, very similar to what we have done in the past, and what we have used in many instances as broadening, or at least basing types of patterns for that next upward advance. So I mean, just to condense this down into a couple of sentences, the markets are still relatively healthy. They are still overwhelmingly bullish. We will be open-minded at least for the continuation of some form of a sort of deeper pullback. But until we start taking out these structural levels which we pay attention to in terms of trends and as technical traders, there isn't really anything to be concerned or alarmed about at this particular time. The S&P 500, a high wave spinning top on Friday. During the week, it was looking as though we were setting up a stair-step type of consolidation pattern that more or less broke down on Friday with this upper wick and this lower wick, again indicating extreme sort of bifurcation and indecision short-term in the markets. But for the S&P 500, the level you want to be paying attention to are these old resistance swing highs that we have overcome. Okay, so we've broken above it. Oftentimes when we get the breakout, we will retest the pivot, otherwise known as the pivot point, and then that will act as, of course, the precipice, or sorry, not the precipice, but the support level that's going to help propel prices higher. So pay attention to that as well. I wouldn't be sort of being swept away with what's occurred on Friday again. Given, of course, the pullback which we saw in the NASDAQ and the sort of the candle of indecision on the S&P 500, the Dow Jones Industrial Average sort of shrugged that off. And you can see that we closed up just under 90 points. This looks as though we are seeing the legitimate trend breakout. You can also see volume advancing as well. If I bring up the ADX and the CCI, you can see the CCI has definitively broken that 100 and the ADX has also turned up as well. So, I mean, we've got some mixed signals across the markets. However, they are in agreement. According to Dow theory, these markets have all broken out to new all-time highs, or at least three widely followed US indices. And again, from time to time, what we like to do, especially when we see a little bit of volatility come into the market, is that we like to see what market breadth is is doing, because it gives us an indication of whether the internals are starting to break down, whether the internals are strengthening. Now, I spoke about this over the weekend in Pro, and as you can see, since basing out here just above 1,340, the Russell has moved quite aggressively, and again in some form of a short-term parabolic move to the upside. And even on Friday, although we do have an upper week, yes, I can see that. Yes, it does sort of resemble and take the form of that of a shooting star, which we need to be concerned about, or at least be cognizant of up and around these levels. It looks as though market breadth, okay, is starting to pick up. It's starting to strengthen, it's starting to advance, and it gives me confirmation, or some form of added confirmation, that these historical highs that we have pushed up into are going to last for a little bit longer until we start to see the breakdown in terms of market breadth. And what I mean by breakdown is that we'd have to see the Russell 2000 break below 1,329, and also this upward trend line if I change to the weekly chart, and this is a back testing trend line, until we see the market break down below this level, break down below this macro support, which has been developing for a number of months now. We need to assume that the trend is still in effect, and you can see that the volume, even Thursday through Friday, I mean, it really accelerated, which is very positive for the markets. You can see the oscillators, which are still confirming the breakout, and again, you've got the CCI freshly printing above that positive 100 signal, with price breaking above, or very close to breaking above resistance. So, I mean, this is somewhat applicable and somewhat true to the transportational average. The transportational average, it hasn't got above, or it hasn't moved above the February and March swing high over here. If I zoom out and put this into a better perspective for you, we are still sort of stuck moving sideways. We are still channeling between some form of a support down here at 8,900 and also a resistance level coming in up here around 9,600, 9,550. But you can see if I change to the oscillators, although we are, short-term overbought, it looks as though this is some form of, again, a stair-step pattern, which at least is going to take us up to 9,600. So there is a little bit of juice in the tank, so to speak, and it looks as though as long as these markets can hold above their respective support levels, which I've already identified for you in this weekend's video, you have to still remain with a relatively bullish sort of outlook, but still be open-minded enough to assume that, look, if we see sellers come in, we would expect these lower levels to hold, and this is only going to be some form of a short-term correction, which is going to allow these oscillators to reset, which is then going to allow us to push on back up into these recent highs, or back above them, and to continue this macro bullish trend. Now, just to give you a quick breakdown in our top 12 individual trade list, I'm not going to go through the stocks. I've done that. It was an hour and a half recording over the weekend. But what we identified were two trades with risk and reward ratios, if they play out, very close. I mean, we're looking at risk reward ratios of 13 to 1. And I mean, that's $1 of risk for $13 of profit on two particular stocks, which, look, they haven't confirmed and they haven't given us that true entry point at this particular point or at this particular time. But I mean, these types of trades are what you want to be looking for in the world of trading financial markets and being an active market participant in the way of, being a swing trader. So we've got trades coming to us. We're in a couple of trades. We've seen a lot of trades work out. We've also seen some stops being taken out with Friday's trading session. We have active capital sort of allocation into some of the ETFs, or at least the diamonds, the SPYs and the Qs. If you've chosen to trade the Qs, personally I'm out of the Qs, but I am in the diamonds and the SPYs, and these are all working out relatively well. You need to remain a little bit patient, obviously, as we sort of, potentially move into the short-term correctional phase. But what I'm trying to say anyway is that we do have some really nice trade opportunity, and there are also additional stocks outside of these two stocks, which I mean, I'm sort of, dancing around without actually giving the ticker away, that are also looking for some pretty decent movements moving into the week ahead. So I'd encourage you to look at that class if you are interested in learning how to break down individual trade analysis. So on that note, everybody, I'd like to thank you for watching this analysis video. It's a pleasure to bring it to you, and I'll be back with you again at some later point to bring you some more market analysis, and also to share with you my thoughts on where these markets are moving and what to look out for in terms of tradable opportunity and everything to do anyway with financial markets as well. So enjoy the rest of your weekend, and I look forward to the next time we meet. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.